With interest rates around 7%, how can you get a rate below 3% to save hundreds or even thousands a month in your monthly payment? We're diving into assumable loans, the pros and cons to them, and how you can use them to score a much lower monthly payment. Or if you're selling, use them to market your home to more buyers and perhaps get a higher selling price. We're covering everything you need to know about assumable loans in this video. Hey everyone, if you're looking at buying a home but you're stunned by the monthly mortgage payments that come along with a 7% interest rate, it could be that an assumable loan could be just the ticket to save hundreds or even thousands of dollars a month. And if you're selling a home, the assumable loan can help give you a tremendous marketing advantage to sell your home. And we're covering all that in this video. Assumable loans aren't really talked about until interest rates get high like they are now. And before I dive into assumable loans, my name is Curtis Chism with the Chism Team. And if you're looking at buying or selling a home with an assumable loan, just reach out via phone, text, or email so we can run through your options. I've got people contacting me all the time, just like you, who have the same concern, and I absolutely love helping them. It's important to note that many agents don't understand assumable loans, so you really want to make sure that you're working with an agent that understands assumable loans, like myself, to help guide both buyers and sellers through the whole process. So just text, call, or email, and let's chat. But first, let's cover what an assumable loan is before we cover pros and cons. An assumable loan is simply a loan that can be taken on by a buyer. So the buyer assumes the monthly payments of the seller and the interest rate. So if a homeowner has an interest rate at 2.75%, the buyer takes over the payment with that interest rate. There is a catch to this, and we'll cover that in the buyer cons section coming up. However, not all mortgage types are assumable. Typically, VA loans and FHA loans are assumable, and USDA loans. Conventional loans typically are not. Some ARMs can be assumed, but that kind of defeats the purpose since they tend to adjust up quite a bit. VA loans represent the biggest opportunity because they typically have the best interest rates. They are almost always assumable, and they can be assumed by a veteran or non-veteran buyer. The buyer also doesn't have to be a first-time home buyer. Selling to a veteran is the best for the seller of the home because it allows the seller to regain entitlement and allows the seller to go out and buy another home with a VA loan. If you're selling to a non-veteran, although the seller has no obligation for the mortgage, the entitlement is tied to that property and cannot use the VA loan until the buyer pays off the loan or refinances out of the VA loan. Many VA loans have rates around 3%, which make it super attractive to buyers. But next up are FHA loans. Now, FHA loans are typically always assumable, and they make for a great opportunity in the lower price range. USDA loans are typically always assumable and are great for rural and moderate areas. Now, there are strict incomes for this as well. Now, there's a few rules to keep in mind before pursuing this too far. The buyer must be an owner-occupant, so you have to be buying this as a primary residence, not as an investment property. The buyer must, of course, qualify for the loan, and the seller typically must live in the house for at least 1 year. Now, let's cover some of the pros and cons to this program. First up, pros for a buyer. It allows the buyer to take over a lower interest rate. Typically, you're going to be dealing directly with a loan servicer, not a loan officer, saving you some closing costs like origination fees, and you're only paying the remaining payment. So maybe 25 years on the mortgage rather than 30 years, for instance. So this is going to save you some interest over the long run because you're only paying 5 years less of payments, 25 versus 30. Now, let's look at some cons. First, you're going to have a higher down payment. That is really the main con to this, and that is that there could be a substantial down payment required. Only the remaining loan can be assumed by the buyer. The buyer then will have to cover the cost between the purchase price of the home and what's left on the mortgage. In other words, let's say there's $300,000 remaining to be paid on the mortgage, and the house is being purchased for $600,000. The buyer would have to pay the difference or the $300,000. So there are a couple ways to overcome this. So first, if you don't have access to that kind of cash, number one, you can use gift funds from friends and family to cover the difference. Second is to get a second mortgage through a lender to cover the difference. Third is to use seller financing to cover the difference. So you'd make payments to the seller at an agreed upon interest rate to cover that $300,000 difference in our example. If the seller charges 6% and you're taking over a loan at 3%, you have a blended interest rate of 4.5%. So this is a huge win-win as it allows you to buy the home potentially with no money down, allows the seller to get their desired price, and the seller makes a little extra money on the interest payments. So some pros for the seller is basically have a huge marketing advantage. You can advertise, you can take over, say, a 3% rate. So that's going to help you attract a lot of potential buyers to your home. So if you have that, you might be sitting on a gold mine to bring in a bigger pool of buyers. It helps create demand and help you get the price that you want. Using seller financing option that I just talked about also will help net you interest earnings on top of the sale of your home. Now, let's take a look at some of the cons. First, it can take longer to sell your home. Now, you and your realtor need to know everything about what the servicer is going to require and how long it will take. Servicers are not as familiar because it just has not been done very much lately, so things could take longer and the exact close date may be unknown. A second con is entitlement for VA loan. As I mentioned previously, if you're selling to a non-veteran buyer and your entitlement will be tied up, making it very difficult to buy another house using a VA loan. Third is qualification of the buyer. The buyer won't be fully qualified until you get into escrow because they have to get qualified with the loan servicer. Now, hopefully they are already pre-approved by a lender, then you know they have a high probability of being approved by the loan servicer. Let's take a look at some best practices with assumable loans. Number one, as a seller, you must get a release of liability from the loan servicer and sign it so you aren't on the hook if the buyer makes the mortgage payments or doesn't make the mortgage payments. Two is talk to your loan servicer at least a month before you put the home on the market. You want to have all your ducks in a row on this before you list your home. Third is a marketing advantage. This gives you a significant advantage if you have this option because you will get a lot more activity on your home. So make sure that you promote this in your marketing. And number four, as a buyer, you want to focus on homes sold in the last couple of years. Otherwise, the seller could have a ton of equity requiring a second loan or a significant down payment. And lastly, number five, make sure you're working with an agent like myself that understands assumable loans so they can work with the servicer, the mortgage officers, and help the buyers and their seller and their agent through the whole process. So wrapping it up, that is a complete overview of assumable loans. If you're looking to buy or sell a home using an assumable loan product or any other loan product, then reach out to me via phone, text, or email, and I'll see you on the next video.